Ah, taxes. They're about more than just property and income tax. And with the tax deadline looming, Dylan Bond, owner of Bond Financial Services, is here because you're telling us how we can set up our retirement accounts but be cognizant of taxes at the same time.
Yeah, we do a lot of work with different types of tax qualified accounts. And first and foremost, I'm not an accountant. I'm not a tax professional. We work with people like Ziemba Tax Services in Chicopee to guide people in that direction. But part of the whole process of a solid financial plan is understanding how different types of accounts and different types of tax qualifications can affect the way you use money at retirement. So you have to be very aware of it no matter what you're doing when you come to your financial planning.
And it takes a team of people, which is why you can work with accountants and lawyers to make sure that people are soup to nuts covered when it comes to their finances. But today, we're just going to discuss a few different kinds of taxes that people might not think about. The first one's capital gains tax.
Yeah, so basically a capital gain tax, and if we focus on long-term capital gains taxes, let's say you bought a stock or an asset at $10, and then 2 years later sold it at $15. Well, you wouldn't pay tax on the $10 you originally spent because you already paid income tax on that.
Exactly.
But what you would do is you would pay tax on that $5 gain that you made on that investment.
And that tax, the percentage that you're being taxed depends on your income level.
Right. So basically, if you're in a 35% tax bracket or less, you're going to pay a 15% long-term capital gains tax rate. If you're in a 39% income tax bracket, you're going to pay a 20% long-term capital gains.
So people have to be cognizant of that. And then also when it comes to, taking out money from your 401k or things like that, you have to be cognizant of this state tax.
I mean, that's one of the bigger common mistakes that I see a lot of people making in retirement is they tend to not consider the income taxability of their retirement accounts, like their 401ks and IRAs, and put yourself in a position where you're in retirement, you're collecting Social Security, you might have a pension that already creates tax, and then you want to buy a second home down south, and you want to come up with another $100,000 or $150,000 to do that. You got to be very careful that you don't go into your IRA or 401k and withdraw that. And in the past, people have done that. I've met people that have come in from one of our seminars because they've had an issue like that, and they're looking for more guidance. But the fact of the matter is, the more money you take out of your retirement accounts, you could put yourself in a higher tax bracket. So we're very aware of that when we're working with the families that we represent to make sure that we have money set aside for lump sum withdrawals if they need it, as well as enough income so that they can pay their bills for their retirement lifetime.
Now, there's also a state tax, and people should consult with a lawyer about that to determine what they need. And then lastly, there's gift tax, and if people have a little extra sitting around, or if they have some dependents down the line, you might want to consider a gift tax.
Yeah, I mean, we use a lot of different types of gifting strategies with certain families, and really, you're allowed to give $14,000 a year.
And that's tax-free.
Tax-free. But you have to be very careful in how you do it and make sure you do it right. But if you think about it, if you're a married couple, you can each give your child or your grandchildren $14,000 a year. So for every person a married couple has in their life that they want to give money to, they could, in theory, give up to $28,000 because each individual can give $14,000. And for people that have a lot of excess money in retirement accounts, that have a lot of taxability when they leave it to the next generation. So one of the more popular strategies is to take that gifting allowance, gift it to the next generation, and buy a life insurance policy, which is tax-free death benefit.
That's a great idea.
So that they can leverage that gift for a big sum of money that might create a legacy, more than just giving them the $14,000 a year and having them go buy a motorcycle and a boat with it.
We don't want that. Now, Dylan, we're running a little bit low on time, but I want to tell everybody about your Facebook page.
Yeah, we've got a Facebook page. We've really ramped it up this year. It's been one of our initiatives. It's been a way that we can get our thoughts for the week out, as well as our appearances on Mass Appeal and things like that.
Those.
It's Bond Financial Services on Facebook. And if you want to go there and like us, you'll be able to access our thoughts for the week and some of our investment advisory groups that put themselves out there in different publications.
So we're out of time, but you got to go to the Facebook page, and then also we have the seminars.
Yeah,
we've
got seminars coming up at Twin Hills and Long Meadow. Best thing to do is call the office, talk to George, and he can give you the dates and availability and more details on that.
Dylan, always a pleasure. Thanks so much for stopping by today. And you can visit bondfinancialservices.net or check out their Facebook page or call them 413-754-4747. Just let Dylan and his staff take steps to secure your financial future.